The most important economic event of our lifetime is unfolding right now. And there's a very good chance your financial plan hasn't considered all realistic possibilities. Every financial plan in existence is built on the same handful of assumptions about what the market will return, what inflation will be, how long you'll live, and how much you'll earn between now and the time that you retire. Those assumptions drive everything. They tell you when you can retire, how much money you can spend, and whether you can afford the life that you've been building toward. Right now, every single one of those assumptions is up in the air because of AI. Not in some theoretical, maybe in 20 years kind of way, but right now, today. Goldman Sachs published a report estimating that generative AI could raise global GDP by 7% over a 10-year period, which is roughly 7 trillion in new economic output. That would be the largest productivity-driven expansion since electricity was adopted at scale in the early 20th century. If that plays out, the stock market rips higher, corporate earnings grow faster than anyone projected, and the people positioned correctly build generational wealth. McKinsey recently also published a report estimating that up to 30% of all hours currently worked in the United States could be automated by 2030. That's 4 years from now. And we're talking about hundreds of millions of work hours across legal, financial services, healthcare, software development, creative industries, and management. If the pessimistic case plays out, we're looking at the largest disruption to labor since the Industrial Revolution. Incomes fall, consumer spending contracts, and the economic engine that has powered portfolio returns for the last century starts running on fewer and fewer cylinders. These are not predictions from people on the fringes. Goldman Sachs and McKinsey are about as institutional and sharp as it gets, and they're describing two completely different futures. So which one is it? The honest answer, the one most people in our industry won't say out loud, is that nobody knows. Howard Marks, the famous investor, wrote a memo in late 2025 called Is It a Bubble? Where he said no one can definitively say whether this is a bubble and that no one should go all in without acknowledging the risks of ruin if things go badly. But by the same token, no one should stay all out and risk missing one of the greatest technological steps forward in human history. A few months later, he wrote a follow up post saying AI is moving so fast that most observers can't keep up with what's happening. And this is coming from one of the most disciplined, measured investors of all time, basically telling you this could be everything or this could be a complete disaster. And the pace of change is faster than most people can process. Let me walk through both sides because if we're going to plan for this, you need to understand what each path looks like. We'll start with the optimistic case. The optimistic case goes something like this. When you dramatically reduce the cost of producing goods and services, you unlock demand that couldn't exist before. Things get cheaper, new industries emerge, and new categories of economic activity get created that nobody anticipated. Think about what happened with the internet, for example. It didn't just make existing businesses faster, it created entirely new sectors like online commerce, cloud computing, social networking, social media, digital advertising, and the gig economy, none of which existed before the internet matured. And collectively, now they represent trillions of dollars in value. Mark Andreessen has been making this case loudly. He's pointed out that we've been in a regime of very slow technological progress for about 50 years, and that productivity growth has been running at roughly half the pace it was between the 40s and the 70s. His argument is that AI breaks that pattern. A massive ramp in productivity leads to a massive ramp in demand, which leads to a massive jobs boom. There's evidence for it too. A Vanguard study that got discussed on the All In podcast recently showed that jobs in AI exposed occupations have seen higher job growth and higher wage growth than the broader labor market. Higher on both counts. So far, the data doesn't show mass displacement. It shows adaptation. If this path plays out, we're entering a period where innovation accelerates, corporate earnings grow, and new companies get created at a pace we've never seen. And the overall pie gets bigger for everybody. Now the pessimistic path. Sam Altman, the CEO of OpenAI, said something in 2026 worth paying close attention to. He acknowledged that the traditional balance between labor and capital is shifting drastically, and that nobody fully knows what to do about it. This is the person that's actually building the technology, and he's telling you the downstream effects on the labor market are uncertain at best. The concern is if the machines can do what knowledge workers do faster, cheaper, and at scale, employers have a powerful economic incentive to replace human labor with automated systems. This already happened in manufacturing decades ago. Factories that employed thousands now run with a handful of people overseeing robotic systems. Previous waves of automation were limited to physical tasks and routine cognitive work, but AI extends into legal analysis, medical diagnostics, financial modeling, engineering, content creation, and strategic decision making. the categories that were supposed to be safe. A paper from researchers at the University of Pennsylvania and OpenAI found that roughly 80% of the US workforce could see at least 10% of their tasks affected by large language models. And approximately 19% of those people could see at least 50% of those tasks impacted. Once you start talking about half of someone's job being handled by a machine, you're not describing a productivity tool anymore. You're describing a restructuring of how the economy actually works. If that restructuring happens faster than new industries can absorb the displaced workers, you get structural unemployment that persists rather than bouncing back in a couple of quarters. Wages fall across broad sections of the economy. Consumer spending, which drives roughly 70% of US GDP, according to the Bureau of Economic Analysis, contract significantly. Corporate earnings suffer because the customer base shrinks, and the portfolio returns that your financial plan is built on don't show up as anticipated. So you have two futures, one where AI creates unprecedented prosperity, and another where it creates unprecedented disruption, both backed by credible evidence and both plausible situations. Your financial plan, the document that's supposed to tell you whether your family's future is secure, was almost certainly built for a world where neither of these things happens. It was built for continuation of the last several decades, with steady growth, moderate inflation, and predictable income trajectories. A world that may or may not exist in 5 years from now. RayDalio has been saying for years that we're in a period of great disorder, that the times ahead will look more like pre-1945 era than the stable post-World War era, period most of our financial assumptions are built on. He calls it the big cycle, monetary orders, political orders, and geopolitical orders that rise, evolve, and eventually collapse. Whether you buy his full framework or not, the underlying observation is hard to argue with. The world is becoming less predictable, and AI is a major reason why. The good news is that planning under uncertainty is not impossible. It just requires a different approach than what most people are used to. Instead of building a plan around a single expected future and hoping it holds, you build a plan that survives across multiple different circumstances. What happens to your financial life if AI drives decades of exceptional growth? What happens if it triggers a prolonged period of disruption? What happens if different industries experience both at the same time, some booming while others collapse? This is scenario planning, and it's how the most sophisticated institutions in the world manage their money. Endowments, sovereign wealth funds, family offices don't build portfolios for one predicted outcome. They build portfolios that hold up across a range of different outcomes. And that's what your financial plan should be doing too. That means stress testing your income assumptions. If your career is in a field exposed to AI, what does your plan look like if income growth stalls? It means stress testing your return assumptions. If the biggest companies in your index are all spending hundreds of billions on AI and the market decides the returns aren't coming fast enough, what happens to your projected portfolio value? It means thinking about your total exposure, not just what's in your brokerage account, but where your income comes from, where your real estate is, how your real estate is valued, what industries you're tied to, and how much of it is correlated with the same AI-driven forces. The families who come through the next several decades in the best shape won't be the ones who correctly predicted exactly how AI would play out. They'll be the ones who built enough flexibility into their financial lives that they could adapt regardless of which path the world took. That holds whether we're entering a second industrial revolution, an unemployment crisis, or something entirely different that nobody's yet imagined. Follow for more on building a financial plan that holds up no matter what AI does next.